Hello students! Today, we will be discussing about the economics of tourism and hospitality. Are you ready? Let's begin. At the end of this lesson, you should be able to explain the role of tourism and hospitality in economic development. Analyze the economic impact of tourism and hospitality on a destination area. Differentiate the direct effects from the secondary effects of tourist expenditures on the economy of the host area. Elucidate the meaning of tourism multiplier and its effect on the economy of the host country. Describe the undesirable effects of the economic aspects of tourism and hospitality, and identify the strategies which can maximize the economic effects of tourism and hospitality. The role of tourism and hospitality in economic development. Several developing countries have used tourism and hospitality development as an alternative to help economic growth. The reasons of these are: first, there is a continuous demand for international travel in developed countries. Second, as income in developed countries increases, the demand for tourism and hospitality also increases at a faster rate. And third, developing countries need foreign exchange to aid their economic development. The Organization for Economic Cooperation and Development, or OECD, has concluded that tourism and hospitality provides a major opportunity for growth to countries that are at the intermediate stage of economic development and require more foreign exchange earnings. Tourism and hospitality is an invisible export which differs from international trade in many ways. First, in tourism and hospitality, the consumer collects the product from the exporting country, thereby eliminating the freight costs for the exporter, except in cases in which the airline used are those of the tourist receiving country. Second, the demand for pleasure travel is largely dependent on non-economic factors such as local disturbances, political unrest, and changes in the fashionability of resorts or countries created mostly by media coverage. At the same time, international tourism and hospitality is both price elastic and income elastic. This means that changes in price and income will also change the demand for pleasure travel. Third, by using specific fiscal measures, the exporting or tourist receiving country can manipulate exchange rates so that those for tourists are higher or lower. Normally, the latter is implemented in order to attract large numbers of tourists than those in other foreign trade markets. Also, tourists are allowed to buy in domestic markets at the same prices as the local residents. The exceptions are the duty-free tourist shops operated in many Caribbean islands and elsewhere. Fourth, tourism and hospitality is a multifaceted industry that directly affects several sectors in the economy, such as hotels, shops, restaurants, local transport firms, entertainment establishments, handicraft producers, and indirectly affects many others, such as equipment manufacturers and utilities. And lastly, tourism and hospitality brings many more non-monetary benefits and costs than other export industries such as social, cultural, and environmental benefits and costs. Now let's go through economic impact. When travelers outside the destination area spend on goods and services within the destination, tourism and hospitality acts as an export industry by bringing in revenues from outside sources. Tourist expenditures also increase the level of economic activity in the host area directly. Many countries have utilized tourism and hospitality as a means to increase foreign exchange earnings to produce investment necessary to finance economic growth. The tourism and hospitality industry's economic impact on a destination area can be immense since it provides a source of income, employment, and foreign exchange. Now let's relate this one to the direct and secondary effects of tourism. In order to measure the economic impact of tourism and hospitality on the destination area, it is important to know the direct and secondary effects of visitor expenditures on the economy of the area. Tourist expenditures received as income by businesses such as hotels, restaurants, car rentals, tour operators, and retail shops serving tourists have a direct effect on the economy of the host area. The term direct means that the income is received directly. For example, a tourist paying in a hotel. So the income received by the hotel is called as direct. Next, indirect or secondary effects mean that the money paid by tourists to businesses are in turn used to pay for supplies, wages, or workers, and other items used in producing the products or direct services bought by tourists. Next is tourism multiplier. The term multiplier is used to describe the total effect for both direct and secondary of an external source of income introduced into the economy. The tourism multiplier or multiplier effect is used to estimate the direct and secondary effects of tourist expenditures on the economy of a country. So now we will illustrate to you the tourism multiplier. A tourist makes an initial expenditure into the destination. This expenditure is received as income by local tour operators, handicraft store owners, hoteliers, and taxi drivers. In the first round of transactions, a hotelier may use some of the money received to buy some supplies, pay some wages, and retain some profits. The income in the second round may be spent or saved, while the employee has received payment for services rendered may spend some of it on rent and some on food and may put some into savings. The money spent on supplies in the third round of the spending goes for such things as seed, fertilizers, and imported raw materials. Any income spent on imports has leaked out of the local economy. This process continues until the additional income generated by a new round of spending essentially becomes zero. Leakage is the value of goods and services that must be imported to service the needs of tourism and hospitality. To estimate the total economic impact on an area, imports must be subtracted from the income generated by visitors. So here is the formula for tourism multiplier. K equals Y divided by E, where K is the multiplier, Y is the change in the income generated by E, and E is the change in expenditure. It is the initial sum of money spent by the tourist. The size of the multiplier depends on the extent to which the various sectors of the economy are linked to one another. When the tourism and hospitality sectors buy heavily from other local economic sectors for goods and services, there will be a smaller tendency to import and the multiplier will be greater than if the reverse were true. A simplified formula for tourism multiplier is K equals 1 minus L divided by 1 minus C minus Cj minus TIC times 1 minus TD equals B plus M, where K equals the multiplier, L is the direct first-round leakages, C is the tendency to consume, Cj is the proportion of the propensity spent abroad, TIC is the direct tax, TD the value of direct deductions or income tax, national insurance, and so on, B the level of government benefits, and M is the value of imports. Most developing economies have an income multiplier range between 0.6 and 1.2, while developed economies have a range between 1.7 and 2.0. The cost-benefit ratio. Those concerned with developing the tourism and hospitality industry, whether a government or a private individual, would like to know the extent of potential benefits and their costs. benefits divided by costs equal the cost-benefit ratio. To arrive at these ratios, the following procedures are used. First, determine where the tourist dollar is spent. Second, determine what percentage of each expenditure leaves the local economy. Third, derive a multiplier effect, a ratio applied to income that reflects multiple spending within an economy. Fourth, apply the multiplier effect to the tourist expenditures to arrive at the total benefits of tourist expenditures in dollars. Fifth, derive a cost-benefit ratio expressed as dollars received or dollars spent. And lastly, apply the cost-benefit ratios to tourist expenditures to provide estimates of income and costs of tourist business to a community for both the private and public sectors. So now let's talk about the undesirable economic aspects of tourism. Some undesirable economic aspects of tourism and hospitality are higher prices and economic instability. Because of additional demand and/or increased imports, tourist purchases may result in higher prices in a destination area. This would mean that local residents would also have to pay more for products and services. Since pleasure travel is a discretionary item, it is subject to changes in prices and income. These fluctuations may result in economic instability. So how to maximize the economic effect of tourism and hospitality? The first strategy that we have is the growth theories. Some economic growth theories have been proposed to maximize the economic effect of tourism and hospitality within a destination area. These are the theory of balanced growth and the theory of unbalanced growth. Proponents of the theory of balanced growth suggest that tourism and hospitality should be viewed as an important part of a broad-based economy. This theory states that tourism and hospitality needs the support of other industries. Its objective is to integrate tourism and hospitality with other economic activities to obtain maximum economic benefit. Tourism and hospitality goods and services should be locally produced. Supporters of the theory of unbalanced growth see tourism and hospitality as the spark of economic growth, while the proponents of the theory of balanced growth stress the development of supply. Supporters of the theory of unbalanced growth emphasize the need to expand demand. As demand is increased through the vigorous development of tourism and hospitality, other industries will move to provide products and services locally. Another is economic strategies. The key to maximizing the economic effects of tourism and hospitality is to maximize the amount of revenue and jobs developed within the region. To attain this objective, some economic strategies have been adopted, such as import substitution, incentives, and foreign exchange. So first, let us discuss about import substitution. It imposes quotas or tariffs on the importation of goods which can be developed locally. It also grants subsidies, grants, or loans to local industries to encourage the use of local materials. Its objective is to minimize the leakage of money. Second is incentives. The wise use of incentives can encourage the influx of capital, both local and foreign, necessary to develop tourism and hospitality supply. The most common forms of incentives are tax exemptions or reductions on imported machinery, materials, and the like, reduction in company taxation by means of favorable depreciation allowances on investment, or special treatment in relation to excise taxes, sales taxes, income taxes, turnover taxes, profit taxes, or property taxes. Third, tax holidays for a limited period. Fourth, guarantee of stabilization of tax conditions for up to 20 years. Fifth, grants for up to 30% of total capital costs. 6. Subsidies guaranteeing minimal level of profit, occupancy, etc. Loans at low rates of interest. Provision of land freehold at nominal or little cost or at low rents. Next, free and unrestricted repatriation of all of part of invested capital profits, dividends, and interest subject to tax provisions. And lastly, guarantees against nationalization or appropriation. Before implementing an incentive strategy, a destination should first examine the performance of the schemes of other countries in light of their resources and development of objectives. Second, research the actual needs of investors. Third, design codes of investment, concessions related to specific development objectives with precise requirements of investors, and lastly, establish targets of achievements and periodically monitor and assess the level of realization of such targets. The third one is foreign exchange. Many countries have placed restrictions on spending in order to maximize foreign exchange earnings. They have limited the amount of their own currency that tourists can bring in and take out of the destination to ensure that foreign currency is used to pay bills in the host region. Tourists may be required to pay hotel bills in foreign currency. Visitors may be required to show that they have enough money for their stay before they are permitted to enter the country, or they may even be required to enter with a specified amount of foreign currency for the duration of their visit. Alright, so that will be the end part of our discussion on the economy of tourism and hospitality. For any question, you may ask your professor. See you!